All right, welcome everybody. Hello, and welcome to Startup Sack's Introduction to Angel Investing in Startups Workshop. My name is Jeff Bennett. I am the co-founder and president of Startup Sack, and with me is Startup Sack co-founder Laura Good. This seminar is primarily targeted at people who would like to explore becoming an angel investor. Although if you're here as a startup looking to learn about angel investing, there may be some relevant content for you as well. But the primary target is for people who are looking to explore becoming an actual angel investor. And for a while, we've been wanting to organize a workshop that introduces the concept of people so they can become angel investors, and also to show how activating more angel investors in our region can benefit local startups in the greater Sacramento economy. As I said, I am the president of Startup Sack, and Startup Sack is a nonprofit organization with the mission to accelerate Sacramento's startup and innovation ecosystem by informing, educating, empowering, and connecting its startup founders and innovators. And that mission and the programs we offer are supported through generous corporate sponsorships, and we'd like to recognize and give a shout out to those sponsors. So thank you to Smud, Witten Law, Bender Insurance, Nivagen Pharmaceuticals, Stoll Reeves, Weintraub Tobin, Holcomb Law Group, Clifton Larson Allen, Modeta Ventures, and Ernst & Young. And I'd also like to give a special shout out to our platinum sponsor, Smud, and share this brief 30-second ad with you that they provided for us.
My friends and I think about the future a lot.
And it's looking brighter.
Because Smud's improving our air.
Helping the planet.
And using technology and new ideas to power healthy communities.
Where we can all live, work, and play.
By 2030, Smud will be 100% carbon-free, so you can live in a clean power city. Join the charge with Smud at cleanpowercity.org.
So thank you once again to Smud and to all of our sponsors. And if you would like to be a sponsor or explore sponsorship of Startup Sack, you can email Laura or myself, Jeff at startupsack.org, or Laura at startupsack.org, and we can have a nice chat because we're always interested in partnering with new sponsors. With that, I think we're going to really get into the meat of the program, and so I'm going to turn it over to Laura Good, my co-founder, and she's going to introduce the agenda for tonight's program and welcome our presenter and panelists. Take it away, Laura.
So thank you for joining us tonight. We're both pretty excited about this being the first seminar that we've done on this particular topic. So we've already done the intro and welcomed you. After we're done with this introduction, John Celeb will do a presentation on what it takes to be an angel investor, give you some information on what angel investing is all about. And then we'll have a panel discussion moderated by Cheryl Beninga that will include 3 angel investors who will share their experience with you and also be open to your questions about how to get involved in angel investing. And then we'll wrap up around 6:55 and let you guys get back onto things. So I'd like to introduce to you John Celeb. I invite you, John, to the virtual podium. John is an active angel investor, former tech executive, and longstanding contributor to the startup community in our Sacramento region. Having spent 3 decades launching new technologies through both small and large organizations, John now serves as an investor, board member, business consultant, and advisor to emerging technology companies. John has been an active angel investor and board member for the Sacramento Angels for the past 9 years, where he currently serves as manager designee for the Sacramento Angels Llc aggregation vehicle. I'll let him explain to you what that is. John also serves as the board chair for the organization behind the lab at AgStart, the largest wet lab incubator for startup companies in our greater Sacramento region. John teaches a startup investor school for angel investors and is a frequent guest speaker on entrepreneurship and entrepreneurial finance. John, thank you for being willing to share your experience and expertise tonight. Now we'll hand it over to you for the next 40 minutes.
Well, let's get into the program then. I've got my toolbar in the bottom of the screen, so I can't get to the view slideshow. There we go. I love how you've got all these overlapping windows with your screen sharing toolbar and everything else.
Whoops.
So I'm gonna give a quick introduction and overview for why potential investors should consider startup investing. And the audience for this, again, is individuals who are considering becoming startup investors. But a secondary audience would be entrepreneurs themselves to really understand how angel investors think about the investment world. Just a quick intro of myself. I think Laura gave the highlights. I've been actively investing as an angel since 2010, on the board for the Angel since 2012. I recently recorded a 5-episode podcast series in conjunction with Fresno State and the Wet Center on a startup investor school, and a lot of the materials that I'm using here we've used previously at UC Davis entrepreneurship seminars, a startup investor school for our own Sacramento Angels, and most recently in the Fresno State Wet Center effort. So we're constantly refreshing the content and trying to make it more informative. What we're going to cover tonight in the 40 minutes is just a quick overview of why consider startup investing for individuals who may be investing actively in other asset classes. We'll talk about who can be a startup investor. We'll give a little bit of the portfolio theory around startup investing and why it's important to be disciplined when you think about startup investing. There's also many non-financial benefits of startup investing. You meet fascinating people. We'll talk about that quickly. And then we're going to shift into looking at the financial life of a startup from a startup entrepreneur's perspective and what the angel's role is in that financial life of a startup. We'll talk about how startup investments are structured at a very high level, but it's important for people to have an understanding of that. There are significant tax law benefits for startup investors that are uniquely related to how a specific investment is structured. And so we'll cover that quickly. And then we'll talk about, at a high level, how investors structure their decision-making, looking at team, transaction terms, timing, traction, and the total accessible market. We'll give it a little bit of a framework. I'm not going to go into that. That's a 40-minute session in the podcast series just on due diligence and decision-making. And then we'll talk at the end briefly about investing as part of a group and connecting with your local startup ecosystem like Startup SAC, and why it's important for entrepreneurs as well as investors to be linked closely in a startup ecosystem. So let's get into that. There was a 14th century English proverb that mighty oaks from little acorns grow. And this is very applicable to startup investing because as angel investors or startup investors, we're investing in tiny acorns that are just trying to find traction, sending down their little rootlets and seeing if they can find water, soil, a little bit of sunlight to grow. And the vision for a startup investor and for the entrepreneurs they invest in is that someday that company will become a mighty oak and a pillar of our society. If you look at the top half dozen or more technology companies that dominate, technology business in the world and globally in America, you look at Apple, Google, Facebook, now Meta, Amazon, Netflix. Every one of those companies was at some point, and frankly not that long ago, a tiny startup company taking their initial investment from angel investors. And so the vision for angel investors is to find those acorns that are going to grow into a mighty oak and provide support and financial investment in those companies. Now, playing the devil's advocate, a mature oak tree releases thousands of acorns every year, only some of which will grow into large oak trees in the future. And so there's a bit of an art to selecting those tiny acorns that may one day grow into a large oak. There is a very big difference between a startup and a large company, similar to an acorn and a majestic oak tree. A startup is a temporary organization. It's designed to search for a repeatable business model, similar to that tiny acorn falling into the dirt, sending down its first tiny little rootlets to see, can it find a sustainable source of moisture soil and nutrients, etc. Some acorns never make it. Some startups never make it. A large established company is like a mighty oak. It's already found a source of water, nutrients, moisture, and sunlight. And it's a permanent organization, really designed to efficiently execute that repeatable business model that it's already found. And so startup investing is not like investing in a large company. It's not like buying a stock from your local broker. Startup securities are not liquid. The pricing is opaque. It's negotiated for each transaction. Opportunities to purchase are only at distinct points in time in most cases. The securities are not listed securities. The opportunities to sell are extremely limited as well, and they're usually controlled in terms of timing by the company themselves. Typically, investors' funds are tied up for several years, if not many years. For investors who are used to investing in listed securities, large established companies, again, the Apples, the Googles, the Facebooks, the Ford, Tesla, et cetera, there's many large company stocks that may be high flyers, but those are extremely liquid. Prices are available online almost 24/7 throughout the day. They're easily purchased and sold through established brokers and exchanges. And investor funds can really be available, within a day or two of calling your broker and selling the stock. Because of the differences between startup securities and large company stocks, we need to treat them differently in terms of how we make our investments. And we're going to talk about that in the slides ahead. You might ask, given all those restrictions about startup securities, why would you consider investing in those? Why not just invest in, established large company stocks, either listed on the NASDAQ or, large components of the S&P 500? Why not invest in an ETF that tracks the S&P 500? Because those get, decent investment returns over time through ups and downs. And historically, they've been very good investments. In contrast to the S&P 500 and NASDAQ, which you can see in this chart, this was some data from some years ago that was analyzed. They average between 13 and 14 or 15% average annual returns. And again, there are up years and there are down years. Venture funds typically can return significantly more, 18% or more. Seed funds and angel investor funds, again, based on the research that was done, looking over a number of portfolios, can get even larger returns, up to 22% average annual returns. Again, not every investor's mileage will be the same, and it takes discipline and a concerted effort to be able to get that kind of return. But the possibilities are out there, and we'll talk about how those possibilities work. We'll talk about some of the things you need to consider to try to get that return. But this is what really attracts financial investors into the angel investing world. Because startup stocks are highly speculative and not liquid, they should always be considered as just a small fraction of your overall investment portfolio. And most individuals who are investing have the concept of a portfolio strategy where they may have very stable, low risk, highly liquid assets as part of the foundation of their portfolio. And on top of that, they may put additional funds that have moderate risk, things like real estate, individual company stocks, or equity mutual funds. At the most speculative tip of that pyramid is where you might have startup equity. An investor should be prepared to lose their entire investment in an individual startup company or their entire investment in multiple startup companies. It's not like putting money in a government bond that is insured that you will get a steady stream of dividends or interest payments over time. Startup equities are a completely different beast. In terms of who can be a startup investor, there's a lot of people who might have ambitions to be startup investors, but it's really governed by the Securities and Exchange Commission here in the United States. Any company that offers or sells its securities must register with the SEC or find an exemption. The company itself is at risk of significant penalties if it sells unlisted securities to the average citizen on the street. Some of the exemptions from having registration requirements with the SEC are if the startup company sells its securities to what are known as accredited investors. So it's really not the government coming after you if you're an investor. It'll be the government coming after the company that sold you those unlisted securities. And they'll hold the company accountable. Now, as an investor in that company, bad things will happen to the company and bad things will happen to your investment. This is why there's a key focus on accredited investors. Just to recap, under Rule 501 of the SEC's regulations, an accredited investor in the context of a natural person, and there's also accredited investors that could be funds or LLCs or other entities. But if you're talking about an individual person, anyone who has an income that exceeded $200,000 in the past 2 years or $300,000 together with a spouse, and reasonably expects the same for the current year, or alternatively, an individual who has a net worth of over $1 million, either alone or with a spouse, excluding the value of the person's primary residence. You'll hear these two measures. There's either an income test or an asset test. And if you have sufficient assets or sufficient income, then you qualify as being an accredited investor. Again, there are other categories of accredited investors, but for the purposes of angel investing, we're just going to focus on these two.
John, there's a question in the chat there from
Sure.
Mark. He's wondering, what if the company you're investing in is based abroad? How?
There's a whole world of law, and thankfully we have a couple of lawyers on our panel. We're going to get into later in the presentation, because there are many risks for investing in startup companies. Companies that are based abroad provide additional risk, additional layers of risk in terms of political risk, geographic currency risks, et cetera. For a company abroad to sell securities to a US citizen, I think that does fall within, largely regulations that the US Securities Exchange Commission would govern. Again, I would be very cautious if you're not an accredited investor to be investing in startup company securities outside the US. There are plenty of risks just in that alone, much less the legal risk that the company might be accused of selling unregistered securities to US citizens. So let's postpone that perhaps to the panel where we have a couple of attorneys who actually practice in that space.
Great idea.
So I talked about there's a portfolio theory of startup investing, and this slide is a little bit tongue-in-cheek, but it has some important lessons. Truth number one is most startups fail. You can't get around these truths. Truth number two is no one can predict which startups will not fail. Otherwise, all of us angel investors would invest only in startups that will not fail, and we could all substantially improve our portfolio returns, but no one can predict that. Truth number three is investing in startups is a numbers game, and I'm going to talk about that specifically in the slides that follow. Another truth is that what ends up, if you wind up with a gain on your startup investment, it usually went down first, and it can be a bit of a roller coaster ride as a startup investor. Part of the thrill of being a startup investor is that roller coaster ride, but it's also got some stomach churning ups and downs. And truth number five is all companies always need more money. Most startups raise capital, and then they raise more capital, and then they raise more capital. And frankly, even public companies continue to raise capital even after they've had a public offering. But truth number six is if you understand the preceding, startup investing can be very lucrative. And I want to emphasize particularly understanding truth number three. Investing in startups is a numbers game. Let's talk a little bit about why it's a numbers game. This chart shows the cash multiple upon exit across a range of startup investment angel investments, over 1,000 angel investments over a period of a number of years. This data is actually from 2007. I've got more recent data, but the benefit of this 2007 data is it was a very, very large sample size, and they were able to report average holding periods as well. To read this chart, if we took all of the startup angel investments that were made in the study, and that was 100% across the horizontal axis, across the bottom, and looked at the cash multiple on exit, over 50% of those angel investments returned less than the money that the angel investors had invested. Typically, they would return zero. So if the angel investor invested $1,000 in each of these startups, over 50% of their investments would have gone to zero. An observation is those companies typically failed an average within 3 years on average. So half of them would have failed within the 3 years, and half would have taken longer. About 30 to 35% of the startup companies did not fail and returned over a period of averaging 3.3 years, between 1 and 5 times the initial investor's capital. So if the investor invested $1,000 or $10,000, they would have gotten between $10,000 and $50,000 within about a 3.5-year period for those investments. And that's good. But there was roughly 10 to 15% of those startup investments that were made in the study that yielded between 5 to 10x or 10 to 30x. And of that, probably 3 to 5% returned over 30x, 30 times the investor's capital. So if an investor invested $10,000 and got a 30x return, they would have gotten $300,000 back. Of course, it takes longer and longer to get some of those large returns. The companies have to operate for a period of time to get to a size or a scale where they can have a significant, extremely high valuation when they have a liquidity event or an exit. That has some impacts on investor mindset, and we'll talk about that in a couple of slides. But another way to read this, another way to interpret this, is if you as a startup investor made 10 investments, each investment represents 10% of your portfolio. Let's say 9 of those investments went to zero, and the 10th returned a 10x return on your capital. That 10x return, by the way, would pay back the losses on all the other 9 investments, and you'd be essentially break even. Imagine if one of those investments yielded a 10 to 30x or even a 30x return. You would have a very significant capital return, even though well over half of your investment portfolio would go on to zero. You would still have across the overall portfolio an internal rate of return that could be very substantial. In this example, even though half the investment failed, the investors got a 20% internal rate of return. I mentioned this was data from 2007, and as you recall, 2008, 2009 were not great years for investment. The same study was repeated in 2016. It did not have as many data points in the sample, but it showed largely similar effects. And based on the smaller sample size, of course, we don't have as much detail on the holding period for each of those investments, but it was done by the same professor, Robert Wildbank, and reported to the Angel Capital Association. In the 2016 data, about 70% of the investments returned less than 1x, and in many cases, 0. But there were still, 5 to 10% of those investments that returned between 10x, 10 to 30x, or above 30x. And again, the internal rate of return on this portfolio, even with that number of failures, was 22% overall. So it's essentially a hits-driven business. You want to get enough investments in your overall portfolio that will return between 10 and 30x or over 30x, 30 times your initial investment. And you can have a very successful return, but you're going to have a lot of stomach churning failures in your portfolio. You have to have the stomach for it. You have to be patient. So in this hits-driven business, the effect you're going to see, similar to how in investing in an individual company, and entrepreneurs understand this, when they're in their early stages, they're spending lots of money and they may have actually no revenue at all for some period of time. They're going to see the net income or the net losses of the investment pile up. So in the early phases, they're going to see losses pile up. And then over time, they might introduce their initial product, commercial launch, they start to see commercial revenue. And as their revenue grows, they kind of pull out of the curve, the J curve, and they can see a very good return over time. But those first few years are painful. The same is true for angel portfolios, based on the data we just showed. For many investors starting an angel portfolio in the first 3 years, you're going to see a lot of those kind of infant early mortality, the company's going to zero. And you're not going to see a lot of positive returns yet, because again, the best returns, the 10 to 30x returns, may come in year 6 and 7 or later. So those first few years, frankly, are brutal. You will see of 10 or 15 investments you make, 7 to 9 of those may go to zero, and you've got a couple that are still running. You don't know if those ones that are still running are going to go to zero, maybe in years 4 to 5, or they might start to eke out a return. And so there's a J curve for angel portfolios. You got to have the stomach to go through that period. It takes patience. But I mentioned it's a hits-driven business. So how do you thrive in a hits-driven category? You got to have a lot of at-bats. If you're going to be an angel investor with a disciplined portfolio, you cannot make 1 or 2 angel investments. Again, the odds of any single investment yielding a positive return, over half of those individual investments will likely go to 0. So if you have a portfolio with only 5 investments, that's this light blue dotted line, on average, the probability of you getting greater than a 1x return is about 50-50. And that's if you have 5 investments in your portfolio. If you have 1 investment, you're down here. Your odds of getting a 1x return might be, 25% or more. If you have larger and larger portfolios, again, you've got lots more at-bats, lots more chances to get a 10x or a better than 10x return. By the time you get to 25 investments in your portfolio, you have a 50% shot at getting a 2.5 to 3x return on your portfolio. If you have 50 investments in your portfolio, it's a 50-50 shot. You could get a 3x return or greater. And so as an investor in startup companies, you've got to have the discipline to think through, I'm going to have to make 20 to 25 investments, maybe 24 investments in startup companies. And so think about how much money you're going to put into the startup investing category, and be thoughtful and diligent about making sure you're not dropping it all on that one you're sure is going to go to the moon. By the way, in that data we showed earlier that investors are making, every single one of these investments, from the 0% to the 100%, those investors who made that decision to invest in that company were sure that that company, that very specific company, was the one that was going to go to the moon and give a 30x return. They were already weeding out the ones that they knew were dead losers from the start. But even the ones that they were absolutely sure were going to go to the moon, 70% of them, 50 to 70% return 0. So you have to be disciplined. You cannot just say, this is the one, I'm going to put all my money on this one company. You've got to have a disciplined portfolio with 24 or more investments. And then you have a reasonable shot at getting a decent portfolio return. A 3x return on your capital within a 5-year period is going to give you that 22% return or more. The overall multiple on this portfolio, this is the 2016 data, was 2.5 times. That calculates out to a 22% internal rate of return. That's better than you would get from investing in the S&P 500 or in most venture funds. But you've got to play the numbers game and not treat it as, I'm going to chase that 1 or 2 winners. So that's the financial detail of being a startup investor. But frankly, most startup investors, most angels I'm familiar with and I work with closely as part of the Sacramento Angels, are also in it for the non-financial benefits. Bob Goff, who leads a sister angel investor group similar to the Sacramento Angels, but the Sierra Angels up in Incline Village near Lake Tahoe. Bob Goff had a mission statement when he initially started the Sierra Angels. It was doing good, having fun, and making money, not necessarily in that order, but making money is not necessarily the first. You've got to feel like you're making a contribution. You're helping startup innovators, be successful, transform the world, make the world a better place. It also helps you by keeping up with innovations and the world and talking to startup entrepreneurs who are doing transformative things. Every startup entrepreneur is doing something that's never been done before in the unique way or with the unique business model that they're doing it. It's stimulating intellectually, and it gives you a front row seat on some of the technical challenges that are being solved. For those of us who've been working in the technology world, maybe as either entrepreneurs within large corporations or entrepreneurs out in the real world, it gives you the thrill of helping companies overcome challenge, the internal gratification of seeing a company growing the business without the responsibility of having to make payroll and having hard conversations with employees when perhaps you can't make payroll. In many cases, entrepreneurs turn into angels because they want to give back. They want to mentor the next generation of bright and coachable entrepreneurs. It's frankly a lot of fun talking to coachable entrepreneurs, talking to them about their challenges and helping them over a couple of the next challenges so they can get to the next level with their business. And it's also the social benefit of working with very bright people, not just the entrepreneurs and their teams, but also other angel investors. Startup investing is really a team sport, and we'll talk about that when we talk about the due diligence process and the way startup investors make decisions about where they're going to invest. It's a lot more fun and a lot less of a crushing challenge when you're doing it as part of a team. Let's take a switch now, though, and talk about the financial life of a startup from the perspective of the startup, and talk about the landscape, the process they go through. Most startups pass through a trajectory or an arc of their business similar to this. They might have an initial idea, formulating their business model. They're talking to customers. They discover, here's a problem that I think I can solve. And they'll go through a phase where they're doing a proof of concept or a prototype to prove to themselves and to those initial customers that they can actually solve that problem with some minimally viable product. They might do another iteration on their minimum viable product to something that actually could be used in practice by real customers. They might go through a customer pilot, alpha test, a beta site, and then they might have something they feel they can launch commercially to a larger number of customers without a lot of hand holding, because customer pilots and the MVP level often takes a lot of hand holding. But when they have a commercial launch of a product that they think they can actually scale the business, and then after launching it, they get 50, 100, 1,000 customers. Now they want to go through business expansion. That might mean bringing on professional sales teams, launching it to new geographies, maybe going nationwide from a regional rollout at their initial commercial launch. And then maybe they're being very successful and they're selling nationwide. They're at a relatively mature level, and they might have a liquidity event, either going public, an IPO, going public through a SPAC acquisition, or there might be a larger competitor that comes and says, I'd like to add your product or service to our portfolio, and we can take you globally to take this product or service to customers, all across the world. And that becomes an exit. That might be the initial point at which startup investors might see their money come back. The challenge financially for a startup is business expenses start here at the idea phase. You're talking to customers, you're devoting time and effort. The opportunity cost of you're not devoting time and effort to a full-time job somewhere else means you have expenses. And unfortunately, for many companies, the repeatable revenue starts here at commercial launch. And there can be years of effort commercializing, reformulating your product, going through different prototypes and manufacturing scale up to get to customer pilots, and then additional revisions going through manufacturing scale up again to a commercial launch. This is what's known as the valley of death, because money gets spent, money gets spent, money gets spent. And if you don't have enough money, you wind up like this cattle skeleton, underneath the saguaro cactus. If you have enough money to get to a commercial launch, then again, you've got all the challenges in the commercial marketplace of dealing with competition, dealing with copycats, dealing with entrenched competitors. And so it can take additional capital in the business expansion phases. So how do startups get through that? They raise money at the pre-seed, seed stage. For a commercial launch, it might be still early stage. They don't have any revenues yet. Now that they've done a commercial launch, they finally have revenues, and they can go to growth stage investors and even late stage investors. And then they might have corporate investors or an M&A or an IPO for an exit. So different classes of investors come in at these different stages. In the various earliest stages of a startup's life, they may go to entrepreneurship programs at local university. They might participate in grants or competitions. The Big Bang competition here at UC Davis in the Sacramento region gives out over $100,000 each year to worthy startup companies. And it's a non-dilutive, non-equity kind of investment. But winning a couple of the Big Bang business competition awards at maybe $15,000 or $20,000 each, doesn't go that far when you've got to hire full-time professional staff to go and pursue your science or your commercialization efforts and launch your product. To do that requires more capital, and that capital typically comes with equity funding. Most companies at this stage have little to no collateral. They don't qualify for bank loans. Most bank loans from regulated financial institutions require 3 years worth of financials, the last year showing profitability. These companies don't even have revenue yet, so they don't really have anything they can qualify for a loan. The only thing they do have is equity. They've got stock in their company, and they can trade that equity for actual cash, spendable cash, by providing equity to friends and family. Friends and family is the typical way that most startups get their initial capital. And that's good for $10,000, $50,000, maybe $100,000. By the time you get to seed stage and looking to raise $700,000 to $800,000, maybe even $1 million to do customer pilots, to do manufacturing scale up. Angel investors are really the game that that's the investor class that you really need to connect with. And then as you get into commercial launch, you can start to talk to early stage venture capital firms, corporate venture groups. There are many different kinds of venture groups. Some of them focus only exclusively on growth stage and late stage financing, but there are a number of early stage venture capital firms, even here in the Sacramento region. But Moneta Ventures, Impact Venture Capital have made investments in the early and seed stages. Angel investors, like our Sacramento Angels Group, have partnered with Moneta Ventures, and we co-invest. So these are overlapping. These are not mutually exclusive. Angel investors can co-invest with venture capital in these early stages. And then in the late stages, maturity and exit, again, companies can raise 30, 50, hundreds of millions of dollars at the late stage. Again, they've got typically a track record, revenue stream. They can show a history of growth over time. And that gives them access to a whole nother class of investors, both corporate acquirers, corporate venture capital, private equity, and even the public markets. We're going to focus on angel investors here in this early seed stage. That's really what we're talking about today. The concepts we're talking about today are also relevant to friends and family, but friends and family typically don't build large portfolios of 30 or 50 startup companies. Frankly, they're at risk because they're putting their faith in a handful of entrepreneurs that they may know well. But angel investors are starting to get to the point where they're building portfolios and they can realistically get to a meaningful number of startup investments to help mitigate some of the risk, the individual risk that they see in those companies. This might seem obvious, but it's worth repeating that angel investors make money by purchasing equity in startup companies at a stock purchase price and later having the promise of being able to sell that company stock or turn that company stock into cash at a higher sale price. It's not always true that their stock sale price is higher than their purchase price. And sometimes there is no sale price. If a company goes bust, the stock is just never sold, and they take that as a loss. Other factors that are relevant are the holding period. And we'll get into a holding period for early stage or startup company investments when we talk about the tax benefits, because holding period is relevant. Let's take a minute and then talk about the specific investment structures, the deal structures that startup investors see, and then we'll get back to gains, holding period, and tax implications. Typical startup investment deals are structured in one of maybe 3 or 4 different types of structures. The most common is equity. Equity is an ownership stake in the startup company. Investors acquire shares representing a direct ownership interest in the company in exchange for cash. The advantages for investors are typical equity deals. Typically, it's a convertible preferred equity in the company. The advantages for investors that there's clear shareholder rights and investor protections laid out in an investor or shareholder rights agreement. There's a clear cost basis for the acquired shares. I paid so many dollars, X dollars, or so many cents per share for each acquired share. The tax benefits in terms of capital loss provisions, capital gains treatment, we'll talk about in a couple more slides, are very clear and well documented. And actually, there's a lot of tax benefits for startup investors in early stage startup equity, because both the federal government and most economists see how supporting early stage startup companies can be very good from an economic growth perspective for the country, as well as for the local region and for the startup companies themselves. And so there have been some very generous tax benefits for investing in early stage startup equity. The disadvantages for early stage companies is that pricing negotiations with the startup entrepreneur can be somewhat painful, especially for very early stage companies that have no revenue yet, and frankly, little to no traction for their company. And so it can be awkward and uncomfortable to directly discuss what's the valuation of your company that would generate, a price per share for your equity. An alternate structure that has been popularized over the last several decades is convertible notes. Convertible notes are debt. They are not stock, they are debt. Investors acquire a note. The note later converts to equity in the company at a value determined by the next qualified financing. Basically, it postpones these painful pricing negotiations or valuation discussions to the next qualified financing, which might be venture capitalists or professional investors coming in who might be in a better position to accurately weigh the valuation of the company. The advantages for entrepreneurs, it's perceived that convertible notes have a simpler equity or simpler legal paperwork structure than equity financing, and it avoids that pricing negotiation. For investors, however, the disadvantages are the note terms rarely provide the shareholder rights or the investor protections that they might find in a comparable straight priced equity round. The acquisition cost for investors is uncertain, both in terms of the timing of the cost for the shares, and the acquisition cost may be much higher than the valuation of the company if it was valued at this instant, at this point in time. And the tax benefits that we talked about for equity investors only begin to roll in after the note converts to equity, which may be 2-3 years down the road for the investor in that convertible note. The holding period time clock for capital gains only begins when the convertible note converts to equity, again, which may be several years down the road. There are several other structures that you may also hear about. SAFE notes have been popularized by an accelerator known as Y Combinator. SAFE is an acronym. It stands for a simple agreement for future equity. It's essentially an option. It's not equity. It's not debt. It's an option where investors receive an agreement for the future issuance of shares if the company survives and if certain trigger conditions are met. It's very simple paperwork. There are standard SAFE documents that are available on the web. But again, unlike equity investments, there are no explicit shareholder rights, no investor protections. It's not debt. There's no interest that accrues. There's no enforceable provisions in the case of non-performance or if the company starts to go south. Debt has at least some protections under law. So the debt holders get first right for any cash that the company may have if it were to file for Chapter 11. There's no mechanism for investors to spur action. In a convertible note, at least there's typically an expiration date that the note will expire in 2 years, and the company has to do something to relieve the burden on the note holders. With a SAFE note, essentially it's open-ended and things can go on literally for years, where the company staggers along, it doesn't fail, but it's not going anywhere, and the investor's money is just tied up, almost, and sometimes forever. The final structure is warrants. Warrants are an option similar to a SAFE, but warrants typically have a little bit more structure around them, and they typically are not standalone. Warrants are sometimes, it's kind of like the seasoning that's kind of dashed in like salt and pepper on a nice dish. Warrants might be sprinkled in exchange for investors taking equity or perhaps being the first investors into a new equity round or the first investors to sign up for a convertible note. They may receive warrants as a result of participating. Warrants, again, are an option. It's very simple. It's a well understood legal structure. The future acquisition cost for shares, if the warrants are executed, is sometimes known. But again, unlike equity investments, there's no specific shareholder rights, no investor protections. It's not debt, so it's not enforceable. In the case of non-performance or bankruptcy, I don't want to go into and belabor these, but most investors prefer equity. And the saying I have is that friends don't let friends invest in safes. Although truth be told, I have made investments in companies through SAFE investments, but it's rare and not preferred. Let me circle back to equity deal terms. This is investing in typically convertible preferred stock. There are a number of agreements that the investor will sign as part of their purchase of the convertible preferred stock purchase agreement, shareholder rights agreement, shareholder voting rights or voting agreement, and a right of first refusal and co-sale, which means they have the right to sell their shares whenever the founders are selling their founder shares. It basically protects the investor from being the last one holding the bag when everyone else is getting out. There are other terms that may be loaded in as part of the convertible preferred equity. In the interest of time, I'm not going to run through those in much detail, but preferred equity sometimes has dividend rights. The reason for the dividend rights is to make sure that the common stock owners, who may be the founders, don't declare a common stock dividend first and kind of release all of the capital that the investors just put into the company. They don't want that flowing back out into the pockets of the founders. They want the company actually to use that money to move forward. So by having preferred dividend rights, they get first right of first refusal for any dividends that are declared. There's also typically liquidation preferences. And again, that's aimed at keeping the capital that the investors just put into the company in the company and not have the founders liquidate the company, because the founders may still own 75%, 80% of the company. So if you put $1 million into the company, those founders could say that they have a claim on 80% of that $1 million, and they might liquidate the company the day after the investors invest. Liquidation preferences is a way of preventing that and making sure the capital is, heads down, focused on furthering the interests of the company. There's other protective provisions: redemption rights, conversion rights, voting rights, etc., anti-dilution rights. Pictorially, I showed that picture of how investors make money. When an investor invests in equity, the purchase price and the timing of the purchase is known. The future stock price and the future timing, of course, is unknown, but at least there are some knowns, some certainty. We'll talk about when investors invest in a convertible preferred note, the purchase price and timing of their stock is actually unknown, and it's at some point in the future. And so it's visually different from an equity pricing round. Let's talk about the outcome space. I don't want to use that term too broadly, but what are the financial outcomes from an investor investing in equity stock? The best case is they get a cash multiple on exit of 10x or more, 30x at the top of the chart here. That's the best case. It's even better when it happens in the very first year after the investor makes their investment. That's not a frequent case, but it would be best. Other things that happen, other potential outcomes, is within that first year, frankly, the company could go bust. It's unfortunate. But the very worst case is where the investor makes an investment and 4 or 5 years go by and the company is struggling along, bouncing along, and then it finally goes bankrupt, 4, 5, 6 years down the road, because the investor's money has been tied up with no gain, nothing back to the investor. And that's really the worst case. The most realistic is in the upper right, where the investor makes an investment. It might take 3, 4, 5, could take 7 years before the investor gets a payout. But when they do get a payout, ideally, it'd be great to get a 10x return on their investment. I outlined specific holding periods here, the 1 year and the 5 year. And I know this is a busy slide, but I want to talk about the tax law benefits for equity investors based on this, this outcome space we talked about. If the investor makes an investment and gets a gain within the first year, that's taxed at the short-term capital gains rate. There's no real way around that, but they had a great outcome. They might have had a 1x to 10x to 30x return. So they will pay taxes at the short-term capital gain rate, which is effectively the same as ordinary income tax rates. If the investor makes an investment in a qualifying small business stock, and most early stage angel stock investments are qualifying small business stocks, rather than pay tax on that capital gain, the investor can defer their gain under Section 1045 of the IRS rules. They can roll that gain over into another qualifying small business stock by making another angel investment. And they can continue to exchange and roll over their gains into new investments, as long as they're qualifying small business stocks, to try to get past that 5-year holding period. At the end of the 5-year holding period, their qualifying small business stock gains can actually be excluded from tax. 100% of the capital gains can be excluded from tax under Section 1202 of the IRS code, the capital gain exclusion for qualifying small business stocks, which excludes the greater of the first $10 million. Hey, I wouldn't mind excluding the first $10 million if I get taxed on the 11th million and the 12th million. I'm not going to cry into my beer. Or a 10x gain on a qualifying small business stock. And this is for each individual stock investment. So if I can have multiple qualifying small business stocks, let's say I have 3 or 5 of those, each of which gets a $10 million gain, I can exclude capital gains on the first $10 million of that investment. So it can be extremely lucrative to have qualifying small business stocks held more than 5 years, or shorter than 5 years, but deferred, rolled over into another qualifying small business stock, because it can exclude the gain. There's another outcome space, however, below the 1x line. If I invest in a stock and it goes bust, I can write off that capital loss as a short-term capital loss. which is essentially at ordinary income tax rates. And I can take that off my ordinary income up to certain limits or exclusions. If it's a qualifying small business stock that I've held for more than 1 year, I can deduct the capital losses against ordinary income. If I was investing in, let's say, Ford or General Motors, a large established company, and had a capital loss after 1 year, I can only write off that capital loss against long-term capital gains, or I can write it off, but only at the long-term capital gain tax rates, which means I essentially get a lower deduction or a lower amount back at the lower capital gains taxes, long-term capital gains taxes, than if I deducted against ordinary income. But Section 1244 of the IRS code allows me to deduct those capital losses from ordinary income. Again, it gives me a benefit. If I have a loss, I can deduct the full 100% of the loss. If I have a gain, I can defer the gain. So very powerful tax advantages for investing in equity, again, qualifying small business stocks. These benefits do not accrue if I was to invest in a convertible note. We talked about convertible notes as being another often popular investment vehicle popularized by startup entrepreneurs, not necessarily by investors, where the investors acquire a note. Typically, it's described as a convertible promissory note. The note might have an expiration of 2 years from the date of issue. There's typically an interest rate. There might be a conversion trigger, typically a qualified financing. There might be a discount on the conversion price. So if I invest, let's say $1,000 today, and the company issues stock in the future at $100 a share, I will apply my $1,000 and I'll be able to buy the shares at maybe 80%. If I get a 20% discount on conversion, I'll buy them at $80 a share. So I get more shares than someone who is buying those shares at $100 a share 2 years in the future. The difference visually for someone investing in convertible notes is that the purchase price for their stock and the timing of that stock purchase is unknown. It could be 2, 3, 4 years in the future. And the future sales price beyond, so I'm going to actually convert the note into equity 2 to 3 years down the road, and eventually that equity will come back to me as cash at a future stock sale price, which might be 5 or 7 years down the road. Both of these are unknowns. So there's just a lot more risk for a convertible note investment. The tax law benefits or lack of benefits for convertible note investments are, again, if I get a return within the first year, it's typically either shown as interest or short-term capital gain. If I get a gain over, maybe it's a 2-year note, and in 2 years the note expires and I get the note paid back, well, I get accrued interest and I get my capital back. And that accrued interest gets taxed at ordinary income rates. So big whoop. It's not a wonderful return. If the convertible note eventually does convert to stock and that stock appreciates, I may have long-term capital gains, which are taxed at a lower rate than ordinary income. But if the note converts to equity 3 years from now, the holding period for my 1202 exclusion, which I talked about for equity, so the note converts to equity, and now the equity tax law is holding. But if I sell my equity 3 years later, I haven't held it for that 5-year holding period. I might have made the investment 3 years earlier for the conversion into equity and 3 years before that, so total 6 years when I invested first in the note. But from the Section 1202 capital gains exclusion, the holding period is only when it converts to equity, which is sometime in the future. So, the tax law is not nearly as favorable for convertible note debt investments as it is for equity investments. And for the losses, it's a long-term capital loss. Again, not nearly as favorable as it would be for an equity investment. We can certainly cover any details about that in the Q&A at the end. So how do investors improve the returns on their portfolio? They're going to make a number of investments. Some of those investments will fail, but the easiest way to improve your investment return is to reduce the number of bad investments, reduce the number of investments that fail. It's possible to improve the returns on the stocks or in the startup companies you invest in by providing coaching and mentorship and connections to those startup companies, helping to help them be more successful more quickly. But depending on the entrepreneur, that's more difficult. The easiest way to improve the portfolio return you have overall is reduce the investments that go to zero. So investors use a variety of frameworks to help make their decision on which companies they invest in. Now, for startup entrepreneurs, this is important. This is how the investors look at you and how they'll assess the risk of making an investment in you and your company as they go forward. And again, this particular slide is the subject of a 40-minute podcast that I just recorded for Fresno State. So I'm not going to go into this in more detail. But the key risk areas, and this is the 5 T's of due diligence, is looking at the team, the TAM, the total available market, looking at that company's traction over time, both in terms of product, service, or technology, but also traction in terms of customer adoption, customer pilots, initial sales, and then timing. I showed a slide earlier about the valley of death. The valley of death occurs because of the timing differences between when expenses start and when revenue starts. The timing is also affected by the burn rate of the company. How much money are they spending month by month as they go through that process of commercializing their technology and getting to a commercial launch? And again, how much money are they burning as they try to raise, the sales force and try to increase the sales and revenue for their products while they're still investing more or still spending more than the revenue that they're bringing in. So timing is critically important in terms of how much money will the team require both now in this current financing, and how much future financial fundraising will they have to do that will actually dilute my investment as an early stage startup investor. And then finally, the final T is terms. I have seen lots of startup companies that had a wonderful team, experienced team, done it many times before. They were targeting large, accessible markets, very large markets that had a critical need for their product. They had great traction. They were, they had good technology, intellectual property protection, patent protection. They had clear financials to grow their business. And then they were offering an investment. Let's say the company, if you projected they executed their plan flawlessly, in 3 years' time, would have probably a $5 million a year revenue stream that if you put a multiple of maybe 5x on that revenue stream, would give them a company valuation in 3 years of $25 million. Thumbs up. But the investment terms they were offering valued the company today at $25 million. And the company hadn't gone through the next 3 years of all the bumps and obstacles and opportunities to get flat tires along the way, COVID, pandemics, global financial crises like we saw in 2007, 2008. So if a company executed flawlessly and avoided all the obstacles in their path, in 3 years would have a valuation that was worthy of essentially what I put in right now. Where's my return for the risk that I'm taking as an angel investor? So the terms of the deal are critically important as well. There's got to be enough of an incentive for investors to take a leap of faith, to undergo all these risks and try to get a return on their investment. If after 3 years I'm holding a stock or security that's going to be worth in 3 years what I paid for it today, to me that's a nothing. That gives me, I should just sit on my money, and in 3 years, if they've executed flawlessly and they look like they're going somewhere, I'll invest at that time, and I can earn interest on my funds between now and then. Why should I invest? Again, there's a lot more to be said on this decision-making framework and the due diligence that is behind it, but suffice it to say that by being careful and thoughtful, investors can reduce the number of bad investments in their portfolio. There's also another big benefit of investing as part of an angel group. Angel groups like the Sacramento Angels, the Sierra Angels, many of the Bay Area angel groups that we co-invest with, they can access wonderful deals. You as an angel investor will access more and better deals by working as part of a group. It'll be a channel for entrepreneurs who approach you, have them go through the due diligence process of the angel group. You as a startup investor, a learning investor in startup investing, can learn the ropes from experienced investors who've been through it before, that know the risks, that have experienced, frankly, the painful lessons that we've all learned in terms of teams that have gone bad, markets that were asserted, but the customers actually weren't there, products that were promised as being ready for launch, but actually had to go through 3 or 4 more expensive revisions and tunings before they could actually be launched. And then again, companies always need more money. So by working with experienced investors, they can help you learn the ropes, learn what questions to ask, learn the discount factor when an entrepreneur puts a pro forma spreadsheet of their financials in front of you, how to go through that and say, yeah, and mark down, here are the numbers we believe in, here's the ones we don't. You can also benefit from the breadth of other angels' expertise in those categories because, our Sacramento Angels Group, we have people who have experience in real estate, in trucking, in many different kinds of medical devices and medical therapeutics. We've got lots of investors who have experience in information technology and all manner of hardware technology, software tech, gaming. Many of the different categories of entrepreneurs that come to us, their industry sectors, we have experienced angel investors who understand and can, tell you whether their income statement and their projections in that particular industry sector make sense or don't pass the smell test. We can also share the burden of due diligence, really chasing through to make sure that the management team, the corporate financials, the company filings are all in order. The contracts they have with their suppliers and their contractors that protect their intellectual property have all been done well. Again, we've encountered and suffered the slings and arrows of every one of those failures, and experienced angels can help you navigate and avoid that. Angel groups can also pool individual capital to make larger investments. We aggregate the investments from our individual investors and make one significant, meaningful investment into a startup company. So on their cap table, they see a large figure from the Sacramento Angels. And when the Sacramento Angels ask them for a quarterly report on their progress, or want to negotiate and get rights in their next financing round, we have a bit of clout, because in some cases we're the largest investor in some of these startup companies. Although there are many other investors in the same financing round, we're the one that has the largest dollar figure associated with it. So we have a bit of clout. As an individual angel writing your own personal check to a startup company, you're going to be a small blip on their cap table, and they may or may not return your phone calls. There's always the promise of better returns. I'm not making any promises, but with good deals, with a strong disciplined investment process and a strong due diligence process, becomes the chance for better returns by reducing the zeros in your portfolio and increasing the share of those investments that provide a good return. And frankly, we make investments that are going to last for 5 or 7 years. Your co-investors in that same investment are going to be with you for 5 or 7 years awaiting return. So we have a lot of fun. Friendships are built, and again, it's part of the teamwork. Angel investing, startup investing is a team sport, and you can have a lot of fun with the shared experiences, both the positive returns and frankly the negatives of the individual investments that work out or don't work out. There are many different angel groups. This is just a map of the Northern California region. All throughout the Central Valley, there are regional angel groups that have some larger or smaller levels of activity. The Bay Area is rife with angel investor groups. Frankly, there's a greater density of angel investor groups in the Bay Area. And so you can have individual groups that have university affiliations like the Stanford Angels and Entrepreneurs, the Berkeley Angel Network. There's an MIT Angels. There's a Harvard Business School Angels. There are individual angel groups in the Bay Area like Golden Seeds that invest and prefer female founders. So there's a host of them. We frequently co-invest with other angel groups. The Sacramento Angels has frequently co-invested with the Sierra Angels, with the North Bay Angels, with Berkeley Angels. A very common scenario over the years that I've been an angel investor with the Sacramento Angels is we will have 3 angel groups or more that co-invest in the same deal. And we actively refer deals back and forth because everyone's hungry for good, well-vetted deals. And we leverage the benefit of now you have significant number of angel investors. This network, the logos here represent about 600 different individual angel investors, many millions of dollars invested annually in the startup community. And through referral relationships, personal networks that we have with investors in these other groups, we have some successes. And we've had disappointments as well. There's no guarantee, but it makes it fun to be part of a social a network. I think Laura Good mentioned earlier that I manage on behalf of the Sacramento Angels, our Sacramento Angels LLC, which is an aggregation vehicle. We aggregate the investments from the individual angels together into one entity and write one check to the startup company. By writing large checks, that gives us access to more and better deals. We're able to attract startup companies that have high investments in high demand. We can meet higher investment minimums. Often a startup investor deal might have a minimum investor minimum that you have to invest $10,000, $25,000 in a specific deal. By aggregating investments from a larger number of investors, we can meet deals that have a $100,000 investment threshold. That would be hard for an individual investor to meet. Typical individual investor who, again, is trying to make 24 investments in startup companies. You might think, yeah, I can write a check for $100,000, but can you do 24 of those checks to build that portfolio that you need to have enough at-bats to give yourself a high likelihood of having a good return? So by investing through an Angel Group LLC, the individual investor has a lower minimum because we aggregate investments from 10 or 15 or sometimes more individual investors. So we can easily reach a $100,000 minimum threshold where individual investors might be running $5,000 or $10,000 checks. Writing $5,000 checks in a hope of getting to 24 investments in your portfolio over the course of 3 or 5 years, it would only take $200,000 to $150,000 to $200,000 at $5,000 per investment to get to 15 or 20 or 25 investments. So by having that lower individual investor threshold, you can have a diversified portfolio of angel investments. The LLC also simplifies the reporting for angel investors. It streamlines communication for the startups because the startups are only providing quarterly reports to our LLC and we distribute them to the individual investors. Sometimes individual investors get lost or left off distribution lists and they hear nothing from the startup company, even though the startup investment might be doing quite well, but they get no reports from the entrepreneur. And we can also increase our group member access to follow-on rounds. We've had rounds where initially we had 5 or 10 of our investments invest in a company. A year and a half later, the company is doing a follow-on round and we have rights to participate in that. And we can allow investors who are part of our group to participate in those follow-on rounds, even though they were not investors in the early rounds, because our group has rights to funnel investment into that follow-on round. And so that gives us some unique advantages that you wouldn't get if you were an individual investor. My last slide, I just want to encourage you, if you're interested in startup investing, connect with your local startup ecosystem. Startup SAC is a great platform to do that. Attend events, go to meetups, network with entrepreneurs because that's where the entrepreneurs are. Incubators and accelerators frequently have demo day events where startups present. Go to those. You'll be able to see, get experience vicariously watching the startup investor presentations, kind of developing a judgment. Does this look like a good presentation or a bad one? I'd caution you, don't jump on the first one you see because they all look good. That's what the startup entrepreneur's job is to make their investment presentation look good. You really have to see, it's like a batter at the batter's box. You've got to see 10 pitches go by before you decide to swing at one, because you'll get a sense for, where's the strike zone? Where do you feel comfortable swinging? Consider signing up as a mentor or advisor in that startup ecosystem. There are Mentor Sacramento events. There was one held at the recent Impact VC Summit. The Carlson Center at Sac State does a number of mentorship events. And entrepreneurs are as eager to meet you as you are to meet them. By having conversations with entrepreneurs, you have no obligation to invest, but by having conversations, at least you can get a sense for, does this feel comfortable to you? Does this feel like something you might want to do? And if you're interested in learning more about angel groups, you can sit in on Sacramento Angels or other angel groups investor presentations. Not being a member, you can sit in as a guest and you'll start to get a sense for what does it feel like to be part of a group and to consider angel investing. There's a number of resources. I'll leave these for the slides, which Laura will distribute afterwards. I just really want to point out the Angel Capital Association is a nationwide organization, has a wealth of information on their website. Some of it's available for you without being a member of the Angel Capital Association. Our Sacramento Angels Group is part of the Angel Capital Association, so we have access to the full resources on their website, and it's really a wealth of knowledge and information. But I'll leave that to you for review offline. And just the thought to leave you with, mighty oaks from little acorns grow. Angel investors are the ones who invest in selecting the acorns that they hope will one day turn into mighty investments, mighty oaks in the landscape. With that, I'm going to turn it over to Laura and facilitating any questions we have if we haven't run out of time.
Yeah, we are out of time for this part, but we are going to let people ask the panel questions after we do the regular panel. And John, we do want you to stay on the panel too and field some of those questions. So what I'd like to do is introduce the panel, hand it over to Cheryl as the moderator, and then let's get a feel for who the investors are on the panel. And then as questions come in, Cheryl, we can decide if it's time to ask the panel those questions or not. And I did ask a few of the panelists, I'm not sure if I asked all of them, but they said they could stay a little bit late if we have more questions. So let's get right to that. Cheryl Beninga is the moderator. Cheryl is a venture investor. I'll let her tell you more about herself, and we'll let the panel introduce themselves. So Cheryl.
Thanks, Laura and John. Excellent presentation. You had to cover a lot in a short period of time, so I'm sure there's going to be a lot of questions for the panelists. My background's more in venture investor rather than angel, and I'm a co-founder of Fourth Wave local accelerator program here in Sacramento for women tech entrepreneurs. And we just so happen to have our investor salon tomorrow. So I'm just putting in the chat an invite if any of you are interested in seeing 10 high potential women tech companies. They are presenting as part of Global Entrepreneurship Week tomorrow. So I'd like to introduce our panelists, or have them introduce themselves and tell a little bit about how they got interested in angel investing. And I'll just go through my screen and start with Tom.
Hi, everybody. I'm Tom Candrus. And I only became an entrepreneur when somebody told me I was an entrepreneur. I was just trying to make payroll, right? So, but anyway, so I had a successful exit in 2017, but I've been an angel investor now probably for about 15 years. And after I had my exit, I kind of started a small private equity fund on my own. And since 2017, I've probably invested in about 36 companies and have invested in some general partnership funds. The newest one is the Growth Factory with Mark Haney. We've already got 15 investees in that deal, and also Black Star Investment with Kwame and Dale Carlson. I'm a general partner in that fund as well. So probably another, 35 or so other companies. So that's close to 70 companies that I've been a party of. So been very active early on. I wish I'd listened to John's presentation many years ago. I think it would have saved me a lot of money, a lot of pain and suffering. But I've become an active entrepreneur for all the social reasons and some of the economic reasons that John had cited.
Thanks, Tom. And I think that's important to bring out the social reasons, and we'll talk more about this in this panel. Michelle, please introduce yourself. Oh, you're on mute.
There we go. Sorry about that. I'm a shareholder and an attorney, and about half of my practice is working with early stage startup companies and other high growth companies, but a lot in the technology space. And I got interested in angel investing and working with those companies, and also working with investor groups, angel groups, and venture capital investors, and representing them in transactions. So I became an angel, I think, in 2003. And I don't know, I have not counted how many investments I've made, but it's been a number of them. And I've learned some things along the way. And I thought John's presentation was spot on in many, many respects. And I think very good advice for people who are interested in becoming angel investors.
Great. Thank you. Omar, please introduce yourself.
Is it unmuted?
Yeah, you're
okay.
unmuted.
Can you hear me? Okay, great.
Yeah.
Hi, good evening or afternoon, everyone. I'm Omar Gonzalez. I'm also an attorney, and way back when I worked with startup companies and different businesses locally in the Silicon Valley. I am a trial attorney by profession, but I'm also a real estate investor entrepreneur and an angel investor. And I've really enjoyed my involvement with the Sac Angels, and I've dipped my toe in several companies, and I look forward to many more. So if anyone has any questions or anything I can answer that may be useful, I'm all ears.
Great, thanks. And John's joining us on the panel. Laura, do you want to tee up a couple questions that came up in the chat while John was presenting for the panel?
Yeah, so there were some questions about minimum investment, like as an angel investor, how much do you need to invest in a company? Maybe John, you could answer that a little bit, or anyone.
So in our experience, and again, I've been investing with the Sacramento Angels since 2010. I ran the selections process for 4 years, and so we were looking at lots of different startup investment presentations. Individual investor minimums typically are between 10 to 25, or in some cases as much as $50 or $100,000 for the company to actually take capital from an individual investor. The challenge is for every startup company investor, the company has to pay their attorneys to go and manage that, and it just becomes a burden for them if they have lots of tiny investors. So they typically set an investment minimum that makes it worth their while. $15,000 to $25,000 is very common. We've had deals where the companies would go as low as $10,000 per individual investor. And that's partly the motivation for why 3 years ago, our Sacramento Angels Group formed the Sacramento Angels Llc, so that we could aggregate funds from our own investors. And then when we write a check to the startup company, it's $50,000 or $100,000 or $150,000. So we rarely get involved in the investor minimum discussion with startup companies. But I know before we had our LLC, it was a very common one, because we had lots of investors that might be willing to write a $10,000 check. Not so many were willing to write a $25,000 check.
And probably to John's comment there, I think that as an investor, we always want to manage the cap table. So I kind of like the investor group concept where they form the LLC, or the agreement to invest as a group. And some of the things that I've learned along the way is tongue in cheek, you can say you want to invest the least amount for the most amount, right? But also, I think what you want to be able to do is assess the need of the company, and so you don't really want to get into a company that's going to nickel and dime you and take investors on for $5,000 or whatnot. So managing a cap table can be very, very difficult. So I would say that investments that I've made are anywhere from 25 to maybe 1.3 million on an individual investment. But I think it's a matter of assessing what the company's needs and your appetite to basically to help and enable and affect change.
Yeah, that's
another
great
issue.
point.
Another issue is when you invest in a company, there may be a minimum investment, and you want to be careful as an investor that you have some dry powder for that particular investment down the road, because you may want to participate in future financings to avoid dilution and things. So you don't want to have all of your marbles in maybe that first round with respect to a company you're interested in investing.
Yeah, for sure.
Yeah, great point. Another question that I think Jeff Heath had: are there any differences in startup focus areas that affect investment strategy and return hopes? Industry, technology, such as healthcare or others. I know that is true. What is your perspective, Tom?
Well, I think it's very true. I mean, you start looking at companies that are hardware driven, and they are multiples of EBITDA versus a SaaS, or a medical device, or cancer research. So it really depends on what your appetite and what your expertise really might be. And you start looking at companies that are very hardware, and you're looking at multiples of EBITDA, which means you have to have revenue, you have to have profits, you have to have good opportunities and cost structure. When you are looking at other companies that are really looking at kind of land grabs and number of hits on their page that get the valuation. So I would caution people to run directly into those guys that are getting multiples of revenue, but and not pay attention to those who are actually building some tangible products. But I think balanced portfolio in both of those type of valuation structures.
I have definitely a comment on this one, and that is that certain companies take a much longer time to get to launching a product. For example, medical devices is classic in that area because there's a lot of regulatory approvals, and then there's clinicals and other things which you need in order to be able to sell the products, even if you have 510(k) approval. So investments in some types of companies, you have to be prepared to either be in it for sometimes 5 to 7 years before the company may even, launch the product. And then on top of that, if there are financings that the company has to undertake between the time that you've invested and when that product may be able to hit the market, there may be other financings the company is going to need. More likely than not, it will need additional financing. So you've got to be prepared to and hopefully have the right to participate in those financings. Otherwise, you run the risk of just getting washed out.
That's right. That's right. One other question that I see coming up is related to, let's see, if a startup is selling after 1 year and it doesn't have an easy answer, oh, okay. I'm not following this question, Laura. Maybe you can get that online. I'm going to move on.
Yeah, let's move on. That one is,
yeah, I was going to have the panelists talk about their perspective of angel investing versus other types of investing, and then maybe give a little bit of color on how it feels to get in connection with the founder, with an innovative technology, and what role kind of that plays versus the pure ROI financial blocking and tackling that John just went through. So maybe, John, I'll have you start on that one, and then we'll go around.
Well, in my presentation, I talked about the J curve for startup investors. In the first 3 or 4 years, you're not going to see any significant exits. You got to be prepared for a lot of losses. The only consolation is you're working with some really exciting, thrilling entrepreneurs. So you've got to milk that for everything you can, because you're not going to get much of a return in your pocketbook or your checkbook. I'm a bit tongue in cheek, but many investors are in it because they just love to work with startup entrepreneurs. They're all doing exciting stuff. They're all doing things that have never been done before. It's very stimulating.
Yeah, Omar, do you want to comment on that?
Sure. I agree with what was said. Can you hear me?
Yep.
Okay, sorry, I'm not so good at this thing. I agree with what was said. And, when I look to invest in whether it's real estate, startup companies or whatnot, I go in thinking, hey, it's really tuition for learning and getting access to the founders. And, frankly, people that are probably smarter than me and that I can learn from and, benefit from as far as sharing ideas, et cetera. And I personally think, when you put money into a startup company, don't expect to see anything, maybe for 6 years, 8 years, and maybe longer. But eventually it's like a nice stew. Takes a while, but when it's finished, more often than not, it's pretty good.
Okay, a nice stew. Michelle, what do you take that view or something different?
I think it depends. I mean, first of all, I think angel investment is a good way to diversify your portfolio. I mean, I think a lot of us are in the stock market in terms of 401ks or certain types of retirement plans, and we have real estate investments, at least maybe the house we live in, or maybe we have some other rental real estate. I just think that angel investment is a good way to diversify. I wouldn't want to have 100% of my investment portfolio in angel investment, but maybe 10% is a decent percentage. I think that the other thing about angel investment is that you do have the opportunity sometimes to invest in companies that you have some affinity with, or you want to help people. I, for example, invested in, and I don't know, Cheryl, if you remember this one, Prolacta years ago. I'm still in that deal. It was back in 2003. This is classic with the medical thing, right? Where it's like, what, 18 years later, and I'm still in the investment. The good news is the company's doing well. I mean, but thank God I didn't invest in it when I was like 65 or something, because by the time, that's something else we have to think about as an angel too, is where you are in your life path and where these companies are in theirs when you make investments. But the company actually had a technology for pasteurizing breast milk, human breast milk, and made products for babies in NICUs, which is a little bit of an orphan drug market, as I think we know. And they really have had great success in helping children get out of the NICUs faster, and then having less developmental disabilities going forward as they grow up. So that was a feel-good investment for me, and I'm glad the company's still doing well and successful. But eventually you kind of are saying, well, where's the exit going to be?
Yeah, no, that's a good point. And I'm interested if some of you are seeing this. What I've seen is, because we have a lot of the venture groups that have, what I would say, moved back. They're coming in later, Series A, Series B. That's where they're putting most of their capital. I'm seeing them in a lot of deals willing to take out some of the earlier people who want to come out like in a B or a C round. Have you been seeing that, John and Tom, in your investments?
To be honest,
I see that there's a lot of the private equity folks and the venture guys are really going out on the Series A, and I'm seeing a lot of the more successful young companies, basically raising cash even prior to that in other forms and taking on some additional investment at different levels of valuation. And I think that they've been very successful doing that. And I think that there's a bigger role for angel investments or small players in the private equity space. But I want to just comment on the prior question, is that, really, I think educating yourself and investing in teams is very good. Look at the diversity of the different SAC angel groups, because sometimes the investment thesis is very different. My experience, I was a SAC angel for a while. And, I think that, the makeup of the group also has a tendency to kind of dictate the type of investments you actually might make. And so, looking at maybe multiple groups, that might, make you comfortable in the type of diversity of investments you want to make. But going back to your other question, is that, I'm seeing a lot of there's a lot of deep money going after some early investments in some of what they consider the more favored the businesses. But I think there's still a lot of room for angel investing.
Great. Yeah.
Responding to your question, Cheryl, of have we seen the larger VC equity groups willing to take out early investors? We might hope for that, but the Sacramento Angels, I don't think we've ever seen that once in the investments we've made. We've done 40 transactions in the last 3 years through our LLC, and not one of them has come back with a follow-on investor offering to take our investment out.
Now,
Interesting.
we actually just did that within the last 2 months with I'm not even sure I should say that, but maybe your attorneys can nod or say don't say it. But I'm an investor and a board member, and we had Series A come in, or actually Series B come in and take out enough. There's two of us, Series A, and some of the management team. So they actually came in and gave us half of the investment. So I thought that was. I think there is an appetite to do that, but I think it's got to be for the right kind of business.
Right. And this is pointing out the important role that angels are playing, because these funds have moved back to more of the later stage. And so angel investing is really taking the place of what you used to see kind of the early stage funds do. And so the sophistication, I think, that you're seeing with the angel groups partnering and doing these LLCs is filling a really important role. How do you all find your deals? What are your deal sourcing mechanisms, and what have you seen work most effectively and recommend to those looking to get into angel investing?
Hey, deals find us. I mean, I don't see any shortage of transaction opportunities.
And once you get a reputation as like Tom has in terms of, being an angel investor and doing the number of investments that he does, people will seek him out. With respect to somebody like me, and because I'm a member of the SAC Angels, my deal flow for the most part, the vast majority of it would come from the SAC Angels.
And our SAC Angels group has a lot of startups come to us. They can apply, on our website, we say how to apply. We also get a lot of referrals from some of the local, the startup ecosystems. We've invested in a number of companies that have come through Egg Start, Clean Start. Startups come to us. Cheryl, with your fourth wave, that's given visibility to a lot of entrepreneurs to get attention from the Sacramento Angels. We get referrals from other angel groups as well. Some of the Bay Area angel groups, Angels, North Bay, Berkeley Angels. They've got deals that they're excited about, but they're not filling out the round, so they come to us, and we love the referral deals because those are the vetted ones. It's not the unwashed where you've got to sift the wheat from the chaff. The referred deals are pretty well, there's meat to them, and it's just a question of whether it meets the the thresholds for each of our investors.
And the investment groups love to work together, upstream and downstream. So if you're an angel investor, the not ready for prime time, if you're a Moneta or DCA or Growth Factory or whatever, there may be opportunities for, hey, they're not quite ready for us, once you take a look at these guys. So I think that other investors really welcome, I don't think there's a lot of coveting the deals necessarily. So I think we like to work together. We like to help good companies and make them ready for the next step.
And just to add to that, Sacramento Angels have co-invested with Moneta Ventures in a number of deals, including Cretelligent and others, where Moneta negotiates a term sheet that's very attractive to investors and then invites us to participate and has other investors participate as well. And we benefit from those relationships. And I think Moneta and the startups benefit by having more kind of local investors behind their company.
I like making those guys the heavy.
They negotiate well.
Cheryl,
Yeah,
can I add something to that?
yeah. Yes, go ahead.
Okay, I would just say to anybody that is inexperienced or that hasn't invested or whatnot, or is interested in investing, is that one benefit that I've seen, a tremendous benefit with the SAC Angels, is just the wealth of just intelligence, knowledge, experience that you get, the feedback, and that's just, I mean, it's priceless. It really is. And you can bounce ideas off people. And that's really what will help drive that. Because, for example, myself, I'll speak personally, when I look at something and I personally, my own investment risk threshold, determine maybe it'll change lives, maybe it'll solve a problem that, society has or whatever, I'm very decisive. I almost immediately decide to invest, and I wire my money. But I like to be able to bounce it off people that have been there, done that. And obviously I make my own decisions and whatever, take my own risk, but I think it's invaluable. And with the SAC Angels, you have access to that. It's an awesome, awesome resource to have.
Yeah, we're definitely lucky to have that group. Go ahead, Tom.
When you build a team, sometimes it's nice to have, I have a team around me, and it kind of protects me from me, right? And so I fall in love with an investment, but I have actually Michelle, in full disclosure, is my attorney. Has worked with me on a number of almost all my deals, frankly. And so part of the team, but I have some financial teams, some administration teams. But I think I'm the ultimate decision maker. But I think that grounding yourself and putting some discipline and some rules around your investment theses, even if you're very broad, I think is going to be helpful, because I want to invest in everybody. I'm an entrepreneur. I want to help everybody that I can. I'm excited for everybody, and I like most people. So it becomes a little bit of a challenge. And I think that I made a lot of investments early, what I thought I made too soon. And I feel that I feel like I've gotten better with respect to creating some discipline around my investments.
That's a great point. Having discipline, having people to bounce ideas and see different perspectives. And this is a very experiential thing, where the more experience you get, the better you get, and no deal goes quite the same way at all times. A question from David Peregrine: How do you protect your position and equity amounts from getting too diluted during later rounds?
Well, I mean, it depends on the documentation in part that you are subject to when you make your investment. And this is one of the benefits, as John indicated, with respect to the LLC that the Angels have set up, because oftentimes the documents for the investments that we make will say that certain investors that invest at a certain level will have a right to participate in future financings. And sometimes that level can be pretty significant. Like you have to have invested at least $100,000 or $200,000. So by virtue of the Angels being able to kind of aggregate their investments through the LLC, they're able to take advantage of those types of provisions that help them prevent getting diluted. And dilution in and of itself is not necessarily a bad thing, because if the company's trajectory is north and it's going north in terms of its growth and revenue and value, if you get diluted, that may not necessarily be a bad thing, because even though you own less of the company, in terms of your percentage interest, the company may be worth, and hopefully would be worth, a lot more than when you originally invested. But dilution can be a problem if you don't, particularly if you don't have the right to participate in future financing. So one of the things that you have to look at, as John indicated in his presentation, is deal terms are really important. And having that ability to participate in future financings, particularly if the company is expected to have multiple additional rounds going forward, is critical in my view.
And I think you got to be careful not to carve out such a great deal for yourself. I mean, it's as it kills me to say that, but you want to encourage follow-on investment, right? So you want good money chasing these companies. So if your deal is so crazy, it's going to scare people away. And
That's
so I
exactly
think
right.
so you want a clean transaction. You want something that is defendable. All my best deals, I've left something on the table for the other guy.
Yeah,
it has to be a win-win, and between the company, the entrepreneurs, and the investors, in my view. And most deal terms for these types of transactions are designed to be that way. And Tom's right. If you get into a situation as an angel group or an angel investor where you're trying to overreach, and the terms you're putting on the table are either not market or they're onerous and oppressive to to the founders and management, then that's going to come back and haunt you as an investor. So you really do want it to be a win-win.
Yeah. Well, I know we're already 8 minutes over. I'm going to wrap up with a last question, and I see some questions coming that are similar to this. What advice do you have for a qualified investor that wants to get started in angel investing? What's your best advice? And then we also have in the chat, how do they learn? How do they sit in on groups that have been mentioned here and get to know what's happening in our area?
Can I offer one comment on that I've learned over these years?
Sure.
You got to paper the deal correctly. I mean, when you don't make any money, the company goes out of business, nobody cares what the document looks like. So you need to have some documentation that if you're successful, that all the other investors can win, and there's not going to be any conflict going forward. And so painfully I've learned over the time is doing the careful work, making sure that you get the right terms, that it's clear and concise, looking at what other monies they have taken in the past to make sure that there's not going to be conflict when and if they're successful.
Yeah. And you have a good attorney helping you do that. I know that. Yeah. So how would someone get started? What's your advice to people on the call?
They first have to be an accredited investor. I think that's critical, because these companies in taking advantage of securities laws exemptions, if they have any non-accrediteds in their transactions, it just increases the amount of cost and paperwork to the companies. So most companies want to limit the investors in their deals to purely accredited investors. So you have to meet those requirements. If you meet those requirements, then You can reach out to Angel Groups and indicate that you're interested in exploring the opportunity to become a member. And, you know, somebody can either bring you as a guest. And John, I mean, I'll have you wade in here for the SAC Angels. If somebody's interested in becoming a member of the SAC Angels and they don't necessarily have a contact within the Angels, you know, to sort of help shepherd them into the organization, is there another way that they can contact the Angels and you know, and express their interest in becoming a member and maybe attend a meeting to see what it's like?
Well, I think the benefit of this this panel being sponsored by Startup SAC, I think Laura Good has an inside track to directing their interest to the appropriate Sacramento Angel board member. But I would just encourage interested investors who are qualified accredited investors to reach out to Laura here at Startup SAC.
And be
There you
ready to
go.
write
I
some
see
checks.
Laura nodding her head in quiet submission that yes, she's gonna get a flood of new requests.
Yeah, and you know, it's a community here in Sacramento, and so there's lots of people who are willing to help you learn, and you know, us as a community working together as early stage investors is very important for our economic growth and just for lifting up our community of entrepreneurs here. So I think you'll find, you know, people really willing to help and talk to you. This group represents most of them. So with that, I know we could go on for another hour or so probably, but it's Global Entrepreneurship Week. Many of us have been on a lot of panels thus far today already. So Laura, I'm going to go ahead and wrap this, let you finish up. Thanks, everybody.
Well,
Thank you.
Cheryl.
Thanks, Cheryl.